My name is Rijaldi Vijaya, and I am a student of the accounting program, class of 2023. Liquidity ratios, definition, types, and their importance in financial analysis. Liquidity ratios are financial indicators used to measure a company's ability to meet its short-term obligations using its current assets. In other words, these ratios reflect how well a company can cover its short-term debts with assets expected to be converted into cash within a year. Liquidity is a key aspect of financial health, as it ensures that a business can continue operations smoothly without interruptions due to cash flow problems. There are several types of liquidity ratios commonly used in financial analysis. The first is the current ratio, which evaluates a company's ability to pay off its short-term liabilities with all of its current assets. The formula for the current ratio is current ratio is equal to current assets current liabilities. A higher ratio indicates a better ability to meet obligations. Generally, a ratio above 1 is considered healthy, as it means that the company has more current assets than liabilities. The second is the quick ratio, also known as the acid test ratio. This ratio is more conservative because it excludes inventories, which may not be easily converted into cash. The formula is quick ratio is equal to current assets, inventories, current liabilities. By focusing on the most liquid assets such as cash, marketable securities, and receivables, the quick ratio provides a more realistic measure of immediate financial strength. The most conservative measure is the cash ratio, which only considers cash and cash equivalents. The formula is cash ratio is equal to cash plus cash equivalents, current liabilities. This ratio shows whether a company could meet its short-term liabilities if it had to rely solely on its most liquid assets. Although a very high cash ratio might seem safe, it may also indicate inefficiency in asset utilization. Liquidity ratios are crucial for several reasons. For management, they serve as tools for making operational and investment decisions. For creditors and investors, these ratios help assess the financial risk associated with lending or investing in the company. A low liquidity ratio might indicate potential cash flow issues or a higher risk of default, while a very high ratio could suggest underutilized resources. However, interpreting liquidity ratios requires context. Industry standards, economic conditions, and the company's own historical performance must be taken into account. A ratio that is too high or too low might not always tell the full story without comparison to relevant benchmarks.